Okay, so today we're going to break down a really complex day in the market. You've got this great news on the surface, but underneath there are some pretty serious risks hiding. We're looking at a rally that feels good, but, well, it might just be built on hope. Let's dive right in. I mean, on the surface, what a day, right? The market just surged. The tech-heavy NASDAQ led the whole charge, up over 1.25%. You see a sea of green like that, and you think, okay, confidence is back.
And then, as if that wasn't enough, Nvidia's CEO drops this absolute bombshell at their annual conference, a $1 trillion number. I mean, that just sent these massive waves of excitement through the entire AI sector, pouring fuel on that tech rally.
And to round it all out, the third piece of seemingly great news was this: a huge drop in WTI crude oil prices, down almost 4%. Now, everyone saw this as a sign that those geopolitical tensions that spooked the market last week were finally easing. So you've got this broad rally, you've got incredible news from the market leader, and you've got oil prices falling. Everything's looking great, right? Well, this is where it gets interesting, because when you look past those headlines, a very different, much more cautious picture starts to emerge. Let's peel back the layers and see what's really going on here. At the heart of today's market story is this major conflict, what the headlines are screaming at us and what the deeper structural data is whispering. Well, they're two completely different things. Just look at how broad this rally was. The S&P 500 up over 1%, the NASDAQ out in front, and even the Dow Jones putting up a solid gain. On paper, this is a textbook risk-on day. It suggests investors are feeling confident across the board. But that's not the whole story. And this slide just illustrates that conflict perfectly. It's like the market had a split personality today. On the one hand, you have all this superficial optimism, right? The stock rally. But on the other hand, you have serious structural caution. What does that mean? It means professional investors were still buying protection, which kept the VIX, the fear index, high. And at the same time, they were piling into the safety of bonds, which pushes yields down. Those are not signs of genuine confidence. Those are the moves of people who are hedging their bets. So what are these big risks that the headlines are just completely glossing over? There are three critical factors at play that this rally is pretty conveniently ignoring. Let's get into the first one and break it down. First up, the whole mess that caused last week's panic, it's not resolved, not even close. The Strait of Hormuz is still effectively blockaded. So that big drop in the oil price, it's really just a technical correction from that massive spike we saw last week. It's not a sign of a real, lasting solution. And get this, long-term oil futures are barely down, which tells you the market is still pricing in a long, drawn-out conflict.
Second, we are heading into a huge week for central banks. We've got the U.S. Federal Reserve, the European Central Bank, and the Bank of England all meeting. Now, the market is desperately hoping for a soft landing, but recent inflation data is probably going to push the Fed to sound more aggressive, more hawkish. And that dreaded stagflation word, that's now being seriously discussed as a real possibility. And third, the market's own internal warning light is flashing yellow. The VIX closed at 23.51. Now, to put that in perspective for you, anything over 20 signals elevated fear. To see a number this high, especially during a strong rally like today, that signals some pretty significant anxiety under the surface. It means professional traders are saying one thing with stocks, but they're doing the complete opposite with their options hedges. Okay, so you've got this incredibly complex picture, a hopeful rally that's trying to cover up some really deep-seated risks. So what do you actually do about it? How should a professional investor position their portfolio right now? Well, the analysis points to a clear, disciplined strategy that separates emotion from action. The absolute key here is discipline. Do not get suckered in by one day's price action. The smart money is maintaining its energy hedges, using things like the XLE Energy ETF. As long as that VIX stays high, they're waiting for clarity from the Fed's meeting this week before making any big moves. This means holding on to your strong core positions, like an Nvidia, but not chasing the rally. And you got to continue investing systematically instead of making emotional, rash decisions. Now, looking ahead, this whole fragile story of this rally, it's about to get put to the test, seriously tested. The headline-driven optimism that we saw today could evaporate very, very quickly, depending on what happens next. Wednesday. Wednesday is the main event. It's a central bank triple header. But the one that matters most, of course, is the Federal Reserve's interest rate decision. And honestly, it's not even about the rate itself. It's about their economic projections and that dot plot. That's what's going to signal their real thinking on inflation and any future cuts. That will set the true tone for the market for months to come.
So, if we boil all of this complex, conflicting information down to just one key takeaway for today, what is it? What's the one thing you really need to remember from all of this?
This is it. This is the key insight. Today's rally was driven by the hope that things are getting better, not by the confirmation that they actually are. That drop in the oil price, it's not a solution. It's just a breather. The real test, the true turning point for this market, that's still to come later this week.
And that brings us to this critical concept that every single investor needs to understand: the hopeful rebound. It feels like a real recovery. It looks like one on the charts for a day, but it's built on wishful thinking, not on solid ground. And recognizing that difference is absolutely key to navigating these volatile markets. And that leaves us with one final thought for you to take with you. Take a hard, honest look at your own positions and ask yourself, are you positioned for the optimistic headline, which can vanish in an instant? Or are you positioned for the more complex, risk-filled reality that is truly lurking just beneath the surface?